Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lucas Topolbe, and I'm pleased to be joined today by Harry Hardy, our Investment Director for Global Bonds. Now, a lot of the bond guys don't get the glory. A lot of the equity guys usually get the glory. But interestingly, the bond market is actually far bigger than the equity market on a global scale. Fidelity's been in the bond business for over 35 years, and we've recently launched a global bond strategy in the Australian market. Welcome, Harry.
Hi there, Lucas. Thanks for having me. I'm really happy to be here. Still kind of getting over the jet lag, so looking forward to this podcast first thing on the Monday morning.
So if we think about the bond market, many people out there won't actually realise that the bond market is much bigger than the actual equity market, yet it falls under the radar. But if we think about markets over the last couple of years, a lot of the action has actually been in the bond market, and particularly more recently with tariff announcements from the US and Liberation Day, we've seen bonds become a lot more prominent in terms of the news. Just take me through some of the key sort of macroeconomic issues that we've seen over the last couple of years impacting bonds.
Certainly. Obviously, well, after the global financial crisis, we had the QE phase, so things were a little bit kind of tamer in that environment. But obviously, we had COVID, really loose monetary policy, QE in overdrive at that point. That led to an inflationary spike. The Fed was a little bit behind the curve. They, for a long time, felt that inflation would be transitory. Obviously, that was misjudged. And as we all know, with the benefit of hindsight, that really wasn't the case. So we had quite an aggressive hiking cycle, in that 2022, 2023 era. So a real spike in bond yields, which was quite painful for many kind of bond investors at that point. Obviously, at that juncture, we got to a higher starting point in terms of yields. So there's definitely been a pickup in client interest, client demand for fixed income assets post that point. We've got to a very kind of eventful juncture recently with the tariff announcements post-Liberation Day. So April was particularly challenging. We had, huge volatility in the bond market. In my kind of prep notes for this, I saw that the 10-year kind of oscillated from, 380 to up to 460. So an 80 basis point swing. But I think what's actually quite important, and that we'd really try to remind ourselves to add a little bit of context. If you actually look at the moves over the month, they really wasn't that severe at all. So if you're on a desert island somewhere and just looked at the, the last business day of March and the last business day of April, not a huge move on the 10-year. Obviously, there was different parts of the curve where the moves were more pronounced, but I think context is kind of really important. I think where we are today is still an attractive point from a yield perspective, and obviously a lot going on. I think that, global fixed income does provide a buffer to one's portfolio.
Yeah, absolutely. And I think that's a really valid comment because a lot of investors over the last couple of years where they had that volatility, bonds haven't necessarily always added that buffer, but we are sort of seeing that come to the fore at the moment, which is quite important. So if we think about the tariffs, and again, we saw a lot of volatility in bond markets around that initial sort of Liberation Day period. As an active manager, we've got a very concentrated strategy, very active, can be quite contrarian at certain points in the market. How do you navigate that environment as an active manager?
I think what's probably an interesting start to respond to that question is if we kind of flash back to the days after Liberation Day and what our views were at the time. Obviously, this is somewhat stale now because we've had that 90-day pause and we don't know where we're going to go from here. But in the real aftermath of the Liberation Day, a lot of our focus was on the China tariff specifically. Whilst tariffs more broadly were at our forefront, the level of tariffs that we got to on China, which peaked at 145%, was a real topic of concern for us. In our view at the time, that was not a level that we felt the world economy could function at. So we were very much in the camp at that time that there was going to be a slowdown, that was going to weigh on growth, the demand for employers' labour going forward was going to be stretched on that front. Obviously, that's changed a little bit. But what we did from an active management perspective is we've had a long-standing position in the fund to be long duration, predominantly in the US. we took the opportunity where we had that rally in yields, not quite at the bottom, granted, but in the low fours to trim our duration position there. So to lock in some profits, to capture some alpha. And then if we actually look at some of our other duration positions, we've had an underweight in Japanese government bonds for some time as well. We had a sharp rally following the Liberation Day events, and we took that opportunity once again to increase that underweight position to take advantage of the moves. And if we kind of take a step back, that's actually been quite a positive alpha driver since Liberation Day. So we've been nimble, we've been active. Where we were a little bit more cautious, we've had a long-standing underweight credit risk position in the fund. That's largely been centered around valuations, which are quite stretched. So if we zoom into US investment grade credit, we've hit points this year where spreads have been at the tightest they've been since 1998. When you kind of reconcile that against our top-down view of a struggling US consumer, potentially the Fed having to maybe do a little bit more than the market expects, that's kind of at odds. We did have that widening, we did have that sell-off in credit spreads post-Liberation Day, but we really did not see that at the time as a all-out buying opportunity. So in that context, we maintained a defensive credit bias, but we tried to do a little bit more beneath the hood, so to speak. So trying to capture a little bit of alpha from a bottom-up perspective, working with our analysts to see, has this name just been indiscriminately oversold along with everything else, and taking those opportunities to top up some of those positions.
So when you talk about tight credit spreads, you're sort of talking about that effectively that the market wasn't really pricing in the risk that you saw as a portfolio manager team in the market.
To be transparent, we've been a little bit early on that underweight credit position. We've had that for much of 2024. So if we kind of flash back to the back end of 2023, we had a long credit position there. We trimmed that position. And coming into 2024, our view, if we flash back, to January of 2024, was that US IG credit spreads did not compensate for the risks associated to our top-down picture that we had built. We've maintained that position. We were a little bit early once again on that. Credit spreads have continued to tighten. But actually, when we were coming into this year, we had maintained that position. And, coming back to some of those contrarian views that we have, we did, receive quite a lot of challenge on that. In the Liberation Day event, we did widen in some issuers 30, 40 basis points. But once again, with all of the unknowns ahead, we just didn't feel that was an appropriate time to really dial up risk in the portfolio. What we did try to do is, like I said, if there was a name that we felt had been a little bit overblown, we did top up some positions in some select autos names, which we felt were less kind of tariff focused. But that's really been the focus, trying to really position the portfolio from a bottom-up perspective.
Sure. So really sort of a cautious approach in terms of the portfolio.
Cautious.
So if we think ahead, a lot of the conversation has certainly been around interest rates, and it's a global thing, but particularly in the US, will the Fed cut? If so, to what extent and so forth? And certainly over the last, I'd say, 12 months, there's been a variety of views ranging from, maybe just a couple of cuts through to maybe 4 more cuts. So it's been a pretty fluid view of the world. What's your view?
So I'm going to give you 2 views, actually. I'm going to give you our base scenario and I'm going to give you our tail risk scenario. So if we're looking at the current market pricing for Fed's funds cuts at the moment, it's around 2 cuts. That is broadly in line with what we see from our base scenario. I think what's actually more interesting and kind of more topical, and I believe that many investors are overlooking this at the moment, is that in a risk-off scenario, so in a scenario whereby we do have a slowdown in the US or we do enter a recession, we feel that the Fed's going to have to cut far more aggressively than what's being priced at the moment. So that could even hit around 200 basis points of cuts. And the reason why we have this view is if we look at the mortgage composition in the US marketplace at the moment, our view is that the transition mechanism has extended considerably. The reason being is that 75% of US households have a fixed rate mortgage of 5% or lower. But if we look at the current market pricing, even including the 100 basis points of cuts that the Fed did last year, those mortgage rates are in the late 60s and in some instances touching on 7%. So if the Fed does need to stimulate the real economy, they're going to have to do far, far more than what the market is pricing. If we also then, take a step back, the vast majority of Americans are employed by small to medium-sized enterprises. So whilst we touched on a few moments ago, US IG credit spreads being particularly tight, so if you're on Apple, Microsoft, Meta, etc., your funding costs are relatively quite loose. If you're one of these small to medium-sized enterprises who's reliant on bank financing, private lending, etc., your rates are around 9% currently.
Right.
So, once again, even in spite of those 100 basis points of cuts last year, if the Fed needs to stimulate the real economy, they're going to have to do much, much more to support it.
Yeah.
Obviously, then if we couple that with all of the tariff uncertainty, not just from a headline perspective of what these firms are having to pay to bring goods into the US and what consumers are having to pay, but the administrative challenges that they face as part of that journey. So once again, we feel in that risk scenario, there's far more to be done by the Fed.
So if I sort of play it back to you, and try and linking it to some of the comments around you had duration. So duration is effectively, I guess, in its most simple way, the sensitivity to interest rate risk.
That is correct.
And so in your scenario, if we do see 4 or more rate cuts potentially, if we do see that weakness coming through, for bond investors, what does that mean? Is that a good thing, a bad thing in terms of returns? What does that mean practically?
I think the answer to that is a little nuanced. I think, broadly speaking, that is positive. Our portfolio is positioned with a long duration bias. So in a scenario where the Fed does have to cut more, there is a slowdown in growth, that would be beneficial from a rates perspective, given that yields would typically move lower in that kind of environment. Obviously, there are other factors at play depending on where you're positioned in the curve. So our overweight duration position is predominantly in that 5 to 10 year part of the US curve. If you were to look maybe a little bit longer out the curve, there's other factors that come into play there. So it could be the tax bill that Congress are debating at the moment, how that impacts the fiscal landscape going forward. But broadly speaking, that would be positive for how we're positioned. I would also say from a relative returns perspective, if we do have that scenario where we have that material slowdown in growth, potentially a recession, the level that we're at in terms of US IG spreads that are around, say, 90 basis points over Treasury, you would likely see a widening event in that. Where we are positioned rather defensively in credit, we would capture returns from that perspective, albeit on a relative basis. And that in itself poses opportunities to take advantage of names that have been hit by the market weakness.
Yeah. So it does really feel like it's a very much an environment where you want to be active in this environment, because there's just a lot of volatility, a lot of activity, and that from an active perspective can be a friend. In a very benign market, it can be more challenging.
I would completely agree with that. And I would say if we kind of zoom in on the strategies that I cover in my role as an investment director on the global aggregate range, if you look at the environments where we've done well, historically it has been in times of heightened volatility. So actually, Rick Patel, the lead portfolio manager on the strategy, his best year was in 2020. And I think that really, plays into that defensive starting point we have in the strategy, the focus on the liquidity. We only buy a name if it's a name that we feel that we can get in and out of relatively quickly. So yes, 100% you're right. In an active fund, in the context of how we're positioned and our philosophy and style, I think we welcome bond volatility.
And in terms of those scenarios, you sort of painted a picture of potentially some economic weakness and so forth, which for a bond investor is actually, it's sort of counterintuitive, but that can be a quite good thing in terms of portfolio. What are some other possible scenarios though? What are some of the left field ones that you're thinking about that maybe aren't your base case, but are certainly maybe a possibility?
I think you have to mention stagflation, right? Yeah. That's on the tip of everyone's tongue. So a scenario where we see a pickup in inflation, a weakening of growth, that is going to be a challenging environment. So I'd say in that stagflationary scenario that we mentioned there, I think it really depends the magnitude of inflation versus the growth picture and the demand for labour going forward. So as we know, the Federal Reserve has a dual mandate of price stability and maximum employment. So even in that stagflationary scenario where we see inflation above the Federal Reserve's core PCE target, their preferred inflation metric, if the labour market does weaken materially, which we think is indeed a risk, we could still see the Fed cutting more than the market expects, even if inflation is slightly above that 2% target range that we have. Much has been made and a lot, we've challenged this quite a lot at times of, sometimes the pushback we receive to our contrarian views is, okay, well, let's have a look at the 2024 labour market data.
Yeah.
It feels quite robust. The headline numbers look great. Okay, unemployment's ticked up, but it's not awful. How we really challenge that is actually we do not believe that the labour market is in anywhere near a strong footing as many do believe. And the reason we believe that is if you look a little bit into the details, 80% of the growth in payroll numbers last year in the US were from two sectors, the healthcare sector and the government sector. Well, we won't go into too much detail, but they're both sectors for many reasons that are facing quite a lot of challenges this year.
Doge in the firing line.
Exactly. So we have that. And actually, if you look at some of the data that's coming out, many Americans are actually underemployed or actually only struggling to find temporary employment. So we think that actually the labour market is nowhere near as strong as many expected. Then if you kind of throw in the tariff noise, the uncertainty, how that's going to weigh on businesses going forward. Once again, I know at the time of recording, we do have that pause, but we don't know what the next headline is going to be. And neither do employers. So let's see how that unfolds.
Yeah. So if we sort of wrap it up and sort of look forward for the next 12 months and there's a lot of unknowns and notably with the tariffs, like it seems to be a moving target at the moment. But what would be maybe a couple of maybe three things that, for the next 12 months you think are going to be really relevant to focusing on? Maybe it's some of the, an economic indicator, maybe it is to see obviously where the Fed goes in terms of rates. What are some of the key things you're focused on?
I'd say the key things that we're actually focused on going forward are, once again, the labour market, how that actually translates into the actual data, some of the soft data that we're seeing. So if you're an American on the ground, your views on how easy it is to get a job, how long it takes to get a job if you're out of work. Some of those are flashing warning signs. So we'll really be monitoring the trajectory of the labour market going forward and how that impacts the pathway of the Fed. Obviously, clearly, inflation's on the tip of everyone's tongues. How do companies absorb those costs? Do they pass those on to the consumer? Do they have scope to even pass those on to the consumer? Because as we've seen that, inflation that we had in 2022, 2023, etc., there's been a real trading down element from US households. So actually that sticker shock of, I'm just not paying for that anymore. Can they afford any higher prices? I'm not so sure, and we're unsure. So we're really going to be monitoring that. Of course, it's the pathway for the Fed, how they flip-flop between their dual mandate. Is it going to be inflation or is it going to be the labour market that really pushes their hand? We do believe, like I touched on previously, even if core PCE is slightly above their target, i.e. inflation is running a little bit higher, if the labour market really does start to weaken, we feel that the hand will be pushed on that front. And we've touched a little bit on the direction of US investment grade, global corporate in general, and spreads. We're at a juncture where they are quite tight. Where are they going to go from here? Technicals remain quite strong. And what I mean by that, a lot of these grinds tighter that we have seen, despite valuations being quite expensive from an all-in yield perspective, they have been quite attractive. So if you're a buy and hold investor, an insurance company, a pension provider, whilst at a spread level, they're not quite attractive. On an all-in yield perspective, they are. So we think that's kind of been a backdrop for quite a while, keeping those tight. Can that continue? We're unsure. We think that, the slowdown in growth, the uncertainty ahead, that will begin to weigh on them at some point. But within that, there are, once again, opportunities from a bottom-up perspective. I would say there are three key focuses at the moment.
Brilliant. So look, feels like bonds are certainly part of the centre stage at the moment. And from a portfolio perspective, certainly an important pillar of a portfolio as we see sort of more positive bond yields, but also correlations between bonds and equities come down a little bit as well, which from a broader portfolio perspective plays that diversification story. So Harry, thank you very much for your time and thank you for your insights.
Thank you. Pleasure to be here.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.